In this presentation, we will take a look at an example for the recording of the entering of a loan and the recording of loan payments. We will put the loan on the books for a loan that was taken and the cash put into the checking account at the point in time the loan was taken, and then we'll record the payments, this time just recording all interest and principal to the reduction of the loan, planning on it to be adjusted with adjusting interest at the end of the time period, end of the month, or end of the year. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We take a look at our open items for January and February. We had open items for January where we had this loan payment. So there was a $50,000 in uncategorized income. And so we put it into uncategorized income because it showed up on the income statement as a deposit. And we have a policy of putting all deposits in as income under the assumption that all deposits to the business checking account will be income unless stated otherwise. This one, of course, stands out because it's a large deposit, even dollar amount. That looks funny, worth us asking about, and not just putting it into income. And so we're going to say, what is that? And we get the answer, well, that's a loan. We took a loan from the bank put the money into the checking account. So that's the one thing that we're going to deal with. And then in February, we can start to think, well, here's a payment that happened in February. And we had a question about which vendor it should go to. We haven't seen this vendor before, or went to the bank, went to Wells Fargo. So the fact that you're paying the bank would make us think, well, maybe it's a loan payment you're making. Why else would you pay the bank this amount? And now that we know that there's a loan, that would make sense that this would be a payment on the loan. So those two kind of questions would typically resolve themselves once we verify that this is a loan and this is a payment towards that loan. And then we can deal with this information, and we're going to put this loan on the books. So if we go into QuickBooks, then we're going to go into our folder and we're going to open up the QuickBooks file, the QuickBooks data file, and I'm going to go into the easy one, so the QuickBooks One file. So this is going to be our simpler method, or our more simple method, and double click on that QuickBooks file. We should also have a backup for you that you can restore as well. Here we are on the home page. We got the open windows open. We open the open windows by going to the view dropdown and open windows list. Now we're going to look for that deposit that we talked about in our open items. As you recall, sorry to pop around here, but we're back here to the $50,000. It went into uncategorized income. Now, of course, it did come out of the checking account, so we could go to the checking account and find it, or to uncategorized income. Let's see both of those options. We're going to go back to QuickBooks. We're going to go to the Reports dropdown, selecting Reports dropdown, go to Company and Financial, and scroll on down to the Balance Sheet Standard. Typically like to start with the balance sheet here, and we're going to go to the Customize Reports, change the date range from 01/01/19 to 02/28/19. That's January 1st, 2019 to February 28th, 2019, and say OK. Then we're going to double check on the checking account, double click on the checking account, and if we scroll down, we're looking for that $50,000. There is the $50,000. So it was a deposit that we made because it cleared the bank, went to the checking account, and we put it into the register under the checking account, and undeposited funds is the other side. If we double click on that, zooming into it, the other side's in undeposited funds. Let's check out the other side. Closing this back out, closing this back out, going back up to the reports, going down to Company and Financial, selecting the Profit and Loss or other major financial statement report, changing the date range from 01/01/19 to 02/28/19, January 1st to February 28th. Then we're going to go down to the uncategorized income. And this is where we put all of the stuff we didn't know where to go that was income related. So we're going to double click on that. And of course, until we adjust these, we see that we're way distorted here because that $50,000 or $60,000 here may not be income. That's why we put it there. So we're going to double click on it. Our assumption was to put it into income because all deposits are income, but we're saying that's probably, may not be proper there. It may be somewhere on the balance sheet. It may be a loan. So here's the amount, and so we need to reallocate this somewhere. So we're going to double click on it, and here it is, the uncategorized income. Now what we need to do with it is we need to take it off the income statement because it's not income. So it's a deposit that's not income. We got the money, but we didn't get it because we earned it from customers. We got it because we got it from the bank and we owe it back. So the fact that we owe it back means it's a loan. And so the other side has to go to a liability account. So all we need to do then is change this to a liability account. So if we look at the dropdown, we can see what QuickBooks has for us in the liability area. So we've got the checking account cash, and then we've got a liability, payroll liability. We do not have at this time a loan payable liability. So I'm going to go ahead and set up the loan payable account. So we'll go here into the account here. And we could go all the way up and say new account. I like to just type in. So I'm going to delete this account. We don't want that. I'm going to type in loan payable. And that way it'll kind of double check that it's not there, because if I typed it in, it would start to autofill. And then when I say tab, it's going to ask, do you want to set it up? And we're going to say, yeah, set it up. Now, I typically don't use the loan here. I usually set this up as a current liability. And again, we have that option. Should it be current or long term? And that's going to be one of the issues we've got to kind of think about when we deal with the loan payable. We're going to have, if it's within a year, it should be short term. If it's over a year, then it should be long term. But this loan could have a short term and long term portion to it, as we'll see. So another area where we as the bookkeeper probably don't want to get into that. We probably don't want to get into short term and long term because, one, the client probably doesn't care about it because what they want is really the profit and loss. And two, they really, when they do care about it, they care about what the loan balance is more so than having the proper breakout between short term and long term. They may not even know what that is. Why would we need the breakout for the short term and long term? It does help for some decision making. And if you need financial statements on generally accepted accounting principles, then you need to do that. So I'm going to go here and we're going to select the other current liabilities. Then we will continue. So it's under other current liabilities, same thing, same information here, so it looks good. So we're going to save that, and that's where we want it now. So now we're just going to save and close, and we've changed the transaction. That's okay. That's what we wanted to do. We're going to say okay, and that's disappeared from this register. So if I close this back out, and we're going to say refresh, it's now gone from the uncategorized income, and our net income has now gone to a loss here. Okay, so that's good. Where did it go? It went to the balance sheet. So note here now it's not going to be included in income, and that's the point, because this is the major form for a small business that's going to be used to make the tax return. So we're going to go back up top to report taxable income. And yes, where did it go? It went into a liability account called loan payable. So if we double click that loan payable, here's the payable. Here's what's owed, $50,000. Okay, so now we're going to record that one payment we saw in February. So if we go to February, we're going to say, okay, there was a payment. I'm going to open items for February. We wrote down that there was a payment going to Wells Fargo on 2/5. Now, we didn't write the dollar amount. It would be nice if we wrote the dollar amount, but we didn't do so. So we can go and find that. Now, it's obviously going to go into the checking account again and probably uncategorized income or uncategorized expense this time. So if we go back here, if we go to the checking account again, now we're going to say, I know there was a payment now that I think was allocated, and it was on 2/5, this Wells Fargo payment. There it is. So you can find it in the checking account here. It's for $944. Probably easier, however, to find it on the income statement or profit and loss because we put it under an account called uncategorized. So let's close this back out. And let's go to the profit and loss. And if we go to and that's in the open windows, profit and loss. And if we go into uncategorized income here, uncategorized expenses here, then we're going to say double click on that item. And we should be able to find this one that is going to the bank again on 2/5 Wells Fargo. So here's this one. We do have a lot of uncategorized stuff. We got to recategorize. Now, of course, that only happens because it's the first month was kind of a mess because it's the first month. We'll know where it goes next month. But here we go. It's the 944. Now, we see that transaction. If we double click on that, we know what it is. The problem is now we know it's a loan payment, so we could put it to loan payable, which will reduce the loan payment. However, there's a certain portion of this payment that's interest and a certain portion that is principal. We don't know what that is because all we did was ask for what it is, and we didn't ask the breakout. The client probably doesn't know the breakout and even if we ask for the loan documentation, which we could do, the loan documentation probably is going to give us just the amount that we have to pay and the number of periods and the interest rate. Probably not going to break out the payments per period, breaking out between interest and principal. So then our option, so even if we got the loan documentation, in other words, it would be difficult for us to, I mean, we'd still have to do some work like an amortization table to break out the proper amount of interest and principal per payment, and or ask the CPA firm to help us with that. So it's almost easier then if we do plan on working with an accounting firm at the end of the time period and letting them make the adjustment at the end to just say, hey, you know, this is what we have, here's the loan documentation, here is our payments, here's how we made the payments. We would like you to just break out the interest portion at the end of the time period so that you can prepare the taxes with it. So therefore, we're just going to make this easy. We're going to say, hey, this needs to go not to uncategorized income or expense, but to that new account that we made, which is the loan payable. And again, normally it would have loan payable and interest. We'd need two accounts down here. But we're just going to simplify it here and work and plan on an adjustment at the end of the time period. So I'm just going to say save and close. And there we have that. Disappears from this account, so it's no longer in uncategorized expenses. Where did we put it? On the balance sheet. So we refresh this. In the balance sheet, then we have our liability. There it is. Double clicking on this. There it is. There's our original liability. Here's our payment to it. Now again, this balance, $49.56, is too low because some of this is interest. And we're depending on a year-end adjustment to just adjust that out, break out the interest portion. The interest portion being the amount that will be used most likely or possibly to reduce income for taxes, to report the taxes. For more accounting information and accounting courses, visit our website at accountinginstruction.info.